Welcome to this in-depth session dedicated to the financial reporting system and legal control. These two pillars are essential to the health and transparency of any organization. Their proper implementation ensures stakeholder trust and market stability. The financial reporting system and legal control are essential to modern corporate management. They represent the primary tools for monitoring and communicating a company's performance. Their importance is recognized nationally and internationally. These mechanisms ensure the transparency of financial information. They allow investors, creditors, and other stakeholders to access clear and understandable data. Transparency is crucial for informed decisions and for preventing information asymmetries. They also ensure the reliability of financial information. A reliable financial statement is one that faithfully reflects the company's financial situation. This is achieved through rigorous accounting principles and control procedures. The entire system is divided into several interconnected components. Each part contributes to a complete and coherent picture of the business situation. Understanding these interconnections is vital to a holistic view. The financial statement is an accounting document that summarizes a company's financial position. It represents a snapshot of a company's financial position at a given point in time. Its preparation follows specific regulations and principles. This document reflects the company's financial position. It shows the amount and composition of assets and liabilities. It provides a clear overview of available resources and financial commitments. Furthermore, the balance sheet reflects the company's financial situation. It highlights cash flows and the company's ability to generate liquidity. It is crucial for assessing solvency and financial sustainability. Finally, the balance sheet reflects the financial situation. It presents the operating results, i.e., revenues and expenses. It allows us to understand the company's profitability and operating efficiency. The financial statement refers to the end of an administrative period, usually the calendar year. This reference period allows for data comparability over time. Closing the financial statement is a crucial moment for company accounting. The balance sheet is composed of the balance sheet. This statement lists assets, liabilities, and shareholders' equity. It offers a static view of the composition of the company's capital. It also includes the income statement. This document summarizes revenues and expenses, determining the financial result for the financial year. It shows the company's operating and financial performance. Another key component is the cash flow statement. It analyzes cash flows from operating, investing, and financing activities. It provides essential information on the company's liquidity. Finally, the financial statements include the notes to the financial statements. This document is an integral, not ancillary, part of the financial statements. Its purpose is to enrich and clarify the numerical data. The notes to the financial statements provide detailed qualitative information. They explain the financial statement items and the accounting policies adopted. They are a key element of transparency. It provides clarification on the data presented in the balance sheet and income statement. It details the movements of certain items and the assumptions underlying the valuations. Without it, the financial statements would be incomplete. It provides a comprehensive understanding of the financial statements as a whole. It allows users to correctly interpret the numbers. The notes to the financial statements are therefore essential for an in-depth analysis. The general truthfulness and fairness clause is a cornerstone of financial reporting. It requires that financial statements be clearly prepared and faithfully represent reality. This principle guides every stage of their preparation. The financial statements must truthfully represent the company's situation. This means that the data must be real and unaltered. Truthfulness is the foundation of trust in financial information. The financial statements must accurately represent the company's financial position. This requires the rigorous application of accounting principles and regulations. Accuracy ensures compliance and comparability. It must reflect the underlying economic reality of the company. This is not just a matter of formal compliance, but of economic substance. The financial statements must be a true reflection of the company's operations and events. The new OIC, Italian Accounting Organization templates provide essential guidelines. These templates are constantly updated to reflect the evolving economic environment. They are a reference for preparing financial statements in Italy. The new OIC formats incorporate international accounting standards known as IFRS. This harmonization aims to reduce differences between national and international accounting practices. It facilitates the understanding of financial statements globally. These regulations ensure uniform financial reporting. Companies that follow the same principles present comparable data. Uniformity is crucial for industry and market analysis. They also ensure comparability of financial information over time and across companies. Comparability is essential for evaluating performance and making investment decisions. It promotes a more efficient and transparent market. A statutory audit is an independent control process. It is conducted by professionals external to the company. Its independence guarantees objectivity and impartiality. This audit is performed by an auditor or a board of statutory auditors. These individuals are qualified professionals registered in appropriate registers. Their expertise is certified and recognized. The primary objective of an audit is to verify the financial statement's compliance with legal requirements. The auditor ensures that the financial statements have been prepared in accordance with the provisions of the Civil Code and other specific laws. This review is a fundamental safeguard. Another objective is to verify the financial statement's compliance with accounting principles. The auditor evaluates the correct application of OIC or IFRS. Adherence to the principles ensures the quality of accounting information. Finally, the audit aims to assess the reliability of the financial statements as a whole. The auditor expresses an opinion on the financial statement's ability to truthfully and accurately represent the company's financial position. Reliability is the foundation of trust. Audit procedures include the analysis of accounting documents. The auditor examines ledgers, invoices, contracts, and other supporting documents. This analysis forms the basis for verifying the records. They include the examination of significant transactions. The auditor selects a sample of transactions to verify their proper accounting and compliance with internal procedures. This risk-based approach is effective. They include reviewing financial statement valuations. The auditor checks that the valuation criteria for assets and liabilities are appropriate and consistent. Valuations are often areas of greater risk and discretion. They include requests for information from company management. The auditor engages with management to understand the policies, estimates, and decisions that impacted the financial statements. This exchange is crucial for a complete understanding. The auditor or the board of statutory auditors express an opinion on the financial statements. This opinion is formalized in an audit report. The report is a public document and of great importance. They certify whether the financial statements provide a true and fair view. This is the core of their work and their responsibility. The opinion may be unqualified, qualified, adverse, or with a declaration of inability to express an opinion. In the event of significant irregularities or criticalities, the auditor must report them. These reports are included in the audit report. They alert stakeholders to potential problems. In some extreme cases, the auditor may refuse to certify the financial statements. This occurs when the irregularities are so serious that they prevent a reliable opinion. A refusal to certify has a very negative impact on the company. Corporate taxation concerns the determination of taxable income. This is the starting point for calculating direct taxes. Correctly determining this amount is essential for tax compliance. Taxable income is the basis for calculating a company's taxes. Income taxes are a significant item on the income statement. Effectively managing them is crucial to financial planning. The transition from statutory profit to taxable income involves a series of adjustments. Statutory profit is the result that emerges from the income statement prepared according to accounting principles. It is not the taxable base. The statutory result is derived from the income statement, as defined by accounting principles. It reflects the company's economic performance according to accounting rules. It is the starting point for tax calculations. The statutory result is adjusted to take into account tax provisions. Tax rules often have different criteria than accounting rules for the deductibility of costs and the taxability of revenues. These differences generate the variations. Increases include non-tax deductible costs. Typical examples are entertainment expenses exceeding legal limits or fines and penalties. These costs, while recognized in the income statement, do not reduce taxable income. They may also include income not taxed under statutory law but relevant for tax purposes. An example is capital gains that are taxable in a given financial year, even if accounted for differently. These changes increase the taxable base. Decreases include costs that are tax deductible but not accounted for. An example is tax depreciation that exceeds statutory depreciation permitted by specific regulations. These adjustments reduce taxable income. They also include non-taxable income, such as dividends exempt from taxation under specific provisions. These incomes, while recognized in the income statement, do not contribute to the tax base. Decreases reduce the tax burden. The goal of this process is to determine taxable income. This is the amount to which tax rates will be applied. Correctly determining this amount is a legal obligation and a corporate responsibility. Taxable income is the basis for calculating taxes due. Careful management of this process ensures tax compliance, avoids penalties, and optimizes the company's tax burden. Thank you for your attention.